We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Fed pivot fever dominated everything as softer U.S. labor data and cooling inflation fueled bets on an imminent policy shift, even as Treasury yields rose on massive supply pressure. Europe wrestled with an unwelcome inflation uptick that clouded the ECB's easing path, while Japan shocked markets with hawkish signals that sent JGB yields to 16-year highs and strengthened the yen. And in China, tech stocks rallied, but contracting PMIs underscored a deeper confidence slide as the property-driven deflation loop tightened. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
If you paid attention to the markets this past week, the one ending December 5th, 2025, it really felt like the entire global financial system was just holding its breath.
It absolutely was.
We weren't trading on, big immediate data. We were trading on hope. The whole story was defined by a very specific, very high-stakes question. Is the Federal Reserve finally ready to pivot?
That tension was palpable. You could feel it in every asset class. I mean, on the surface, investors were cheering resilient tech earnings. They were looking at signs of easing inflation.
The good news.
The good news, exactly. But if you actually looked underneath the hood, the economic data was, well, incredibly mixed. And what's truly fascinating here is how that speculation, just the expectation of a rate cut, became the ultimate puppeteer this week, pulling all the strings.
But more than the fundamentals themselves.
Far more.
Okay, so that sets up our mission perfectly. Let's unpack how that one expectation drove markets everywhere. US, Europe, UK, Japan, and China. Let's start right where that speculation was loudest. North America. U.S. equities saw some modest gains. The S&P 500 edged up, 0.31%?
That's right. And the NASDAQ led the charge with a 0.91% increase.
But this wasn't excitement over spectacular growth right now. It was all forward-looking, wasn't it?
100%. The market is basically skipping the present and looking straight to that upcoming Fed meeting, the FOMC meeting, for any confirmation that a rate cut shift is coming.
And that brings us to the paradox of the week.
Yes, the market cheered bad news.
So tell us about the bad news the market absolutely loved.
Okay, so the key piece of data came from the ADP private payrolls report. It showed that private sector jobs actually declined by 32,000 in November.
Wow.
Yeah, that's the sharpest drop we've seen since the beginning of 2023. And while that sounds worrying, it's exactly the kind of cooling the Fed wants to see. It fuels the belief that they have room to ease policy.
So the labor market is cracking just enough to justify the pivot. But then on the other side of things, we saw some really encouraging signs of resilience. The whole Goldilocks narrative is kind of building.
It is, because inflation is also playing along. Core PCE, the Fed's absolute favorite measure, it held steady at 2.8% year over year.
Which is the lowest since early 2021.
And it maintains that 4-month downtrend. So price pressures are definitively calming down.
And demand didn't just fall off a cliff. In fact, we saw strength right where people feared weakness. Services?
Correct. The ISM Services Index actually climbed to 52.6. That's its strongest reading since February. This is huge because it suggests that while the labor market is cooling, the rest of the economy isn't collapsing.
It's the perfect soft landing story.
It's the perfect narrative. You have a softer labor market, cooling inflation, and a service sector that's holding up. It suggests the Fed's work is done.
Okay, that all makes perfect sense for stocks, for high-yield bonds. They rallied. But here is the genuine puzzle for me this week. If the market is so sure about rate cuts, why did Treasury yields climb so sharply?
That is the million-dollar question.
The 10-year yield jumped to 4.14%, its highest in a month. I mean, usually when cuts are coming, bond yields fall. What gives?
This is where traditional correlations really broke down this week. You're right. We saw strong risk appetite. People were buying risky assets, but they were not buying long-term Treasury bonds.
So why not?
It's a couple of things. First, investors still feel like they aren't getting paid enough to lock their money up for 10 years, with all the uncertainty. But the bigger issue, the more structural one, is supply. The U.S. government is still issuing a massive amount of debt.
Right.
So even if dovish expectations increase demand, that relentless supply pressure is keeping a lid on bond prices and stopping yields from falling. It's risk appetite colliding head-on with supply concerns.
That's a critical distinction. Okay, let's move across the Atlantic to Europe. Markets there were mixed. The STOXX 600 was up a little, about 0.41%, but the big headline was an unwelcome inflation surprise.
Absolutely. The Eurozone's disinflation story hit a bit of a snag. Headline inflation ticked up to 2.2% in November.
Just a little over forecast, but still.
Still, even though core inflation was stable, that headline number really complicates things for the European Central Bank.
Why does one small tick complicate it so much?
Well, because the ECB has a much narrower mandate than the Fed. They are laser-focused on price stability. A surprise uptick, no matter how small, makes it really hard for them to signal aggressive easing. It just shakes their confidence a bit.
But if you look past that inflation number, the region's economy actually showed some surprising strength.
It did. Europe's economy is fragile, for sure, but it's not broken. We saw Q3 GDP growth get revised upward to 0.3% thanks to France and Spain. And then you had a real standout number from Germany.
The factory orders.
Yes, Germany's factory orders for October popped 1.5% month over month. That tripled what everyone was expecting. So the industrial engine isn't completely stalling out.
Which brings us to the UK. It feels like they're always fighting their own unique battles, but the UK housing market is just defying gravity right now.
It really is a story of resilience. Nationwide's index showed a 0.3% rise in house prices in November. That's the third straight monthly increase.
In this rate environment.
Exactly. Borrowing costs are way up, but demand is holding firm. Mortgage approvals are still solid, around 65,000 in October. It suggests households are just more resilient than we feared.
But there are still clouds on the horizon, right? Especially with the fall budget looming.
Oh, for sure. The outlook is definitely clouded by those fiscal headwinds. The government needs to repair its finances, which could mean spending cuts or tax hikes. And all that uncertainty keeps a lid on investment, even if the housing market is trying to look on the bright side.
Okay, let's pivot. Let's leave the West and head east, because this is where the central bank story is completely fracturing. We're talking about a great divergence, and it really starts in Japan.
This is one of the biggest global stories of the week, hands down. Japanese equities were split. The Nikkei up, the broader two picks down all because of a very hawkish, very unexpected turn from the Bank of Japan.
Governor Ueda hinted at a rate hike in December.
He basically did. For the first time in what feels like forever, he suggested they might hike rates at the next meeting.
That is massive. Japan has been the global outlier for so long. What's the justification for such a dramatic shift?
He pointed to two things: diminishing risks from the U.S. economy and, crucially, rising domestic inflation in Japan. He feels confident they can finally start to normalize policy.
And the market reaction was immediate.
Instantaneous. The 10-year Japanese government bond yield spiked to 1.93%. That is a 16-year high. And at the same time, the yen strengthened into the 154 per dollar range.
But here's the question. Can the BOJ actually pivot without crushing consumer confidence? It's already so fragile. Household spending just fell 3.0% year over year.
That is the core tension. It's the tightrope walk. He's balancing a currency crisis against a confidence crisis. The weak yen has been a huge headache, driving up import costs.
So a hike helps the yen.
It does. But as you said, Japanese consumers are already pulling back. A rate hike risks pushing them right back into their shells, stalling what little growth they have. It's maybe the toughest job of any central banker right now.
And then there's China. We saw gains there. The CSI 300 up over 1%, but this was all about AI and chip stocks. It feels like a classic case of tech optimism masking some deep macro gloom.
It's absolutely selective optimism. If you look at the underlying reality, the economic momentum is weak. I mean, the official manufacturing PMI is still in contraction, 49.2. That's 8 straight months below 50.
And services are now weakening too.
That's the even bigger concern. The non-manufacturing PMI just dropped below 50 for the first time since early 2023. This isn't just a cyclical slowdown. It points to a real collapse in confidence.
Is it all coming back to the property crisis?
It's creating a deflationary feedback loop. The real estate problems are trapping household wealth, which erodes confidence so people stop spending. That fuels deflationary forces. They're relying on the tech sector to carry the load, but the broader economy is fundamentally soft.
So after this incredibly divergent week, what does it all set us up for? Let's look at the week ahead, December 8th to the 12th. It feels like the entire universe is going to align on Wednesday.
Wednesday is the day. The main event is the Fed's policy decision and Chair Powell's press conference. That is the moment markets have been pricing in for weeks.
And just before that, we'll get the data that will either confirm or deny those labor market cracks.
Exactly. On Tuesday, we get the Joel test report, which will tell us about job openings. Then on Thursday, we get weekly jobless claims. These numbers will be critical in seeing if that private payroll drop was a fluke or the start of a trend.
And internationally.
A few key things to watch. Germany's balance of trade on Tuesday, and then China is busy. Trade balance on Monday, and then crucially, their inflation rate on Wednesday, right before the Fed.
Plus UK GDP on Friday. And it's worth noting Japan is quiet ahead of their big meeting, right?
Right. They've scheduled no major releases. Any news will likely come from deliberate comments, keeping speculation high.
So what does this all mean for you, the investor? We've distilled the 5 critical risks you need to have on your radar. Let's run through the watch list.
Okay. Risk number 1 is the sheer size of the expectation around the Fed. Let's call it Fed policy pivot or pause. Markets are pricing in an 87% chance of a cut in 2026. If Powell sounds even a little too cautious, it could jolt everything.
Risk number 2. U.S. labor market cracks deepen. That private jobs number was concerning. We need to watch JOLTS and jobless claims very closely. If that slack accelerates, the narrative can flip from soft landing to recession warning in a heartbeat.
Risk number 3, a Japan rate hike surprise. A pre-holiday move by the Bank of Japan would be historic. It's a major volatility risk for global currency and bond markets. If the yen strengthens rapidly, that sends ripples everywhere.
Back to China for risk number 4. China's deflation risks grow. That inflation data on Wednesday is key. If it's weak again, it could revive those broad global growth worries. A slowdown in the world's second-largest economy doesn't stay in China.
And finally, risk number 5. Sticky Eurozone inflation delays ECB cuts. That little uptick we saw complicates things. Every delay in Europe puts more pressure on the Fed to do the heavy lifting for the global economy, and that increases the risk of a policy misstep right here.
So to quickly summarize the week, markets are inching higher, mostly powered by that Fed cut optimism. But underneath, the global data is throwing curveballs from Japan's hawkish turn to China's slowdown. The balancing act is incredibly delicate.
It is. And despite the obsessive focus on the Fed, the real takeaway for me is that the challenges in China and the potential tightening in Japan mean that, for the first time in years, the global market story might actually pivot away from Washington and toward Asia.
A multipolar central bank world.
A truly multipolar central bank reality. You've got one major economy trying to tighten while others are getting ready to ease. That divergence is going to create opportunities and risks that we just haven't seen in a very long time. Keep an eye on those Japanese bonds. They might be more important than treasuries for signaling what's next.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.